Welcome back, traders and investors. Our final guest today is Todd Schoenberger, and he is founder and managing partner at LandColt Capital. Todd, how you doing this morning?
I'm doing great, Joel. Thanks for having me.
Okay. Before we talk about your LandColt Capital, you served as an executive director for brokerage for USAA Brokerage in San Antonio. And from what I see here, when you started there, it was a loss leader, and by the time you left, they were making money. How does a brokerage firm lose money?
Well, at USAA, the company it's a Fortune 200 company, and they cater to the military, but the heritage of the company is clearly with insurance. And so the brokerage division was actually served as an accommodation for the military members. So when I took over, the company was just losing money left and right, and through my efforts and the team's effort, we were able to turn it around and actually turn it into a nice profitable business. But more importantly, Consumer Reports had recognized it at that point as being a number one brokerage product on the planet. So that was a big plus for us. We're very proud of that.
How did you turn it around?
Well, mainly from cost cutting. That was one issue, because the thing with brokerages at that time in 2006, there were a lot of do-it-yourself brokerage houses that were out there, and commissions were generally, they were commoditized at that point. So what I was doing was I was looking at the business that we had, but we were charging way too much in commissions. That was issue one. And issue two was really the revenue share from the non-USAA mutual funds that were on the platform. And one thing I recognize is being in a competitive environment, you need to be competitive. You need to make sure you're getting your fair share. And when I joined the company, USAA was not actually taking advantage of a lot of the revenue splits that they could have been. So that was something that I had utilized, and it was great, and it was a great accomplishment. I was very proud of that. And to this day, actually, USAA Brokerage still ranks as one of the better products that are out there for investors.
Okay, so you took your knowledge and experience from that, and you started LandColt Capital. Tell us, why you decided to do that, and then tell us about your company.
Well, the origin of it actually started when I was at USAA, because the idea was we were catering to the military. We were catering to investors that were private enlisted soldiers that were going through combat missions in Afghanistan at that time. So I wanted to create a product that was, one, very transparent for an investor to understand, and number two, was something that they could understand, something that was easy for them to understand. So the idea of LandColt, the soul of it, was really to create, utilizing that criteria, but also make something that an investor would not only understand, but be able to follow. And so using those tools and that guideline, I just created the LandColt investment model. And actually, it had started as a test with USAA and with its members. And then from there, when I left, I just took it on my own.
Okay, so you're helping people manage their money?
Right. So the idea with that was to actually take the investment model back then and offer it as a separate managed account for USAA members. When I did it on my own, I actually started it as a subscription service, and then from there it actually migrated to being offered to advisors as well as individual investors.
Okay, so now you have definitely been in the market for quite a while here. You have a good perspective on the ups and the downs here. Tremendous run in the market here. We have pulled back, off the all-time highs a little bit. What's your feeling for the market here over, let's go short term, let's say over the next few months, and then longer term?
Okay, well, in the short term, it's clear as day that investors need to be cautious. And the reason for this is because you're starting to see the clues. You've had so many analysts over the last 18 months that had been screaming for this correction that's supposedly going to happen. And we started with the poor weather. We had the raw winter, the polar vortex. You saw some negative earnings reports that came out, a negative GDP print that we just saw, yet the market still unconditionally continued to keep rising. And so now, what do we have? We have geopolitical risk. You have oil prices that are dancing at 107 a barrel. That takes away from discretionary incomes because gasoline prices move higher. So finally, investors are starting to see what is taking place, and now they're being very cautious. Another big clue on this too, Joel, is when you start looking at the equity outflows over the last 6 weeks. We've seen equity outflows in mutual funds of $13.3 billion, and nearly $16 billion has moved into bond funds. That's a signal to me that the Main Street investor is getting smarter now. They don't want to be trapped in seeing some of these equity investments that they have and start seeing lower valuations. So therefore, they're capturing these gains. They're taking advantage of this upswing that we've had in the markets, and therefore they're bracing themselves for a slide. And I think we're starting to see that right now.
Okay, but then longer term, you still are maintaining your bullish thesis.
That's right. So longer term, you can only suspect that when you start seeing issues with fiscal policy, budget policy coming out of Washington, you're still going to have problems with not just growth rates here in the U.S., but also globally. So what do? Well, guess what? You have the saving grace of the central banks around the world. So therefore, with that type of injection that comes and help that comes from a lot of these central banks, that's really the reason to be bullish, because you have to assume that the central banks are not going to let a global crisis take place. And I know that sounds so false and manufactured as an excuse to be bullish, but the thing about it is that it works. We saw it with QE, with the QE programs, and because of here in the U.S., and because of that, that's the reason to be bullish. So in other words, if you're an investor, be cautious right now in the short term, but if we do go into correction mode, that should be your green light to get back into the market.
Okay, what about all the mergers and acquisitions going on in the market? You know, it kind of sometimes is symptomatic of a market top. Companies are, using their stock to purchase, other companies to, keep their earnings per share up and to keep the growth up. Does the step up in the merger and acquisition arena, is that throw a caution flag to you?
That's a brilliant question, and I tell you what, one thing to keep in mind also, it is a caution flag, but think about why you have so many mergers and acquisitions happening right now. It's really a matter of the inflation threat. Keep in mind, over the last few years, companies were actually, when you start seeing earnings, their earnings benchmarks were lower, and at the expense of human capital, companies, S&P 500 companies, were able to beat these earnings reports, or at least meet them, even though they were lowered expectations. So they weren't hiring people, they're cutting costs, they're laying off people. You see that in the jobs report. And now, with any type of a threat of inflation, you have mergers that are taking place. But it's not for the company. It's not even for the market share, the acquiring company. What they're looking for is cash flow. You have to continue, if you have any threat of inflation, you have companies that have to continue to find additional streams of cash flow. How do you do that? You buy an existing company. Therefore, moving forward, even with lower expectations on the earnings calendar, you can still suspect that you will have companies that will still beat, at least on the revenue line, and therefore, if that's the case, then that's still a bullish sign for stocks. So, yes, you are right that typically, historically, has shown a market top. That's another key piece of evidence to really be cautious in the short term. But yet again, in the long term, you will start seeing some of these companies actually take advantage of some of these acquisitions, and therefore it should help their revenue targets.
Okay, I mean, I know you're in the fund, you have the funds and everything, and they encompass different ETFs and whatnot. Do you have any favorite stocks out there that you like to follow?
Well, I got to tell you, if I'm an investor, I'm looking to own the oil companies. I mean, the Dow Jones Oil and Gas Index has outperformed, has actually more than doubled the S&P 500 this year. And as boring as they may seem, when you start thinking of the big three with Exxon, ConocoPhillips, and Chevron, those are core investments. Those are your clear-cut core investments for investors. And the reason for that is because they continue to do well. And when you have oil prices, any type of geopolitical risk, it's actually an enviable business model, because as oil prices move higher, these companies are still making money. And they might not make money on the franchise side, but they're making money off of the oil that they have off of those royalties. So I have to be, if I'm an investor, I want to hold on to those companies. I'm a big bull in the oil and gas sector. And especially now, here we are in the peak driving season. Historically, oil companies have done well trading-wise in the summer. But then something we don't even talk about is the ancillary part of this that could happen is with hurricane season. You have any type of cut in supplies, you're going to see oil prices go through the roof. Here's something for your listeners, Joel. Human beings consume 85 million barrels of oil a day, yet we're only pumping 86 million barrels out of the earth each day. If those numbers crisscross, any type of supply disruption like we're seeing in Iraq, you're going to see oil prices move higher. And that's why oil is up 2.3% over the last 3 trading sessions.
Wow, great answer to that. All right, got a tough one for you. Tough question coming out here from Truly Ann in the chat room. As options traders, timing is very important. So determining timing, is very difficult. Could you give us an estimate on the short-term pullback? And then she says followed by growth. So it's tough to be a market timer, I guess, is what she's saying. But she just wants your insight on that.
Okay, well, very, very difficult to be a market timer. It's actually, it's just like flipping a coin. Short term, though, realistically, this market is going down 10%. One thing you can take a look at is the VIX. You have the volatility index is up 10% this week alone. We can only anticipate that continuing for the second half of this year. You have lower volumes, obnoxiously lower volumes, I should say. And now going forward, you have, because of lower volumes, you have less players in the markets as well. Don't forget, you have a lower percentage of investors that are taking place. When you look at the volatility, violent volatility that's taking place, you can only suspect if you're trying to time this market, think short term, with higher volatility, lower markets. So short term, realistically, this market's dropping another 10%.
Okay, with the recent outflows, do you see healthy dividend-paying stocks and utilities doing well?
Wow, great question. I mean, clearly it's going to be your safe haven, your flight to quality when you look at that, if you're looking for cash flow. The one thing about this stock market, the argument that has been made is that investors that are looking for yield, that's why the markets are moving higher, because they're finding yield in the markets. Granted, I'm a big believer. Everybody talks about asset allocation. I'm a believer that nobody ever got rich off of asset allocation. So it's best to have a core and explore type of model. Therefore, if you're looking to explore maybe 20, 25% of your portfolio and something that's really aggressive in options, that might be an idea. But your core holdings, there's nothing wrong with looking at utility companies right now. And also keep in mind, utility companies do well, and you hear a lot about this with utility companies seeking increases in rates for this year, for this coming winter. Expect another raw winter, and therefore you're going to have bigger cash flows, bigger dividends for those utility companies. I think that's a good pick, something for investors to look at.
Wow, great answer there. Okay, we've had Todd Schoenberger, and he is founder and managing partner of LandColt Capital. Todd, thanks a lot for coming on today. You gave us some great insight into the market and answered our questions. Thanks for coming on. We hope to speak to you again soon.
Thank you, Joe. I really appreciate it.
Okay.